Are you tired of seeing headlines promising to make you rich by investing in gold? Oh God, I am too. Don't be fooled. While gold may seem like a safe bet, it's actually quite risky and volatile. In fact, there are many reasons why you shouldn't invest in gold at all. But don't worry, we're here to help guide you toward better financial practices. Keep watching to learn about the dangers of gold and where your money should be going instead. Welcome back to Financial Flipside, your one-stop place for all your financial information and tips. We assist you with personal finance and provide you with all the knowledge regarding financial literacy. To remain up to date and access related videos and content, don't forget to hit that subscribe button and notification bell. When it comes to investing, gold is often seen as a safe bet. However, it's important to consider the risks before putting all your money into this precious metal. Why shouldn't you invest in gold? Number 1. Gold is risky. Gold has long been considered a safe haven investment, but the truth is that it can be quite risky. One of the main reasons for this is that gold prices are subject to market fluctuations and geopolitical events. The price of gold can rise or fall depending on a variety of factors, such as economic indicators, inflation rates, supply and demand dynamics, and political unrest. All these factors make predicting the future value of gold extremely difficult. Another factor that makes investing in gold risky is its lack of intrinsic value. Intrinsic value is a measure of what an asset is worth. Unlike stocks or bonds, which represent ownership in companies, or debts owed by corporations or governments, gold doesn't have any underlying assets backing up its worth. Instead, it's just a precious metal whose value depends solely on what someone else will pay for it. Investors also face risks from scams associated with buying physical gold, like frauds related to purity levels or fake coins, making them vulnerable to financial losses if they don't do their due diligence before purchasing. Number 2. Gold is more volatile. It's important to remember that gold is more volatile than many people realize. This means that the value of gold can fluctuate significantly over short periods, making it a risky choice for investors who are looking for stable returns. One reason why gold is so volatile is because its price depends on a variety of factors beyond basic supply and demand. As a result, the price of gold can be highly unpredictable and subject to sudden shifts. Another factor contributing to gold's volatility is its popularity as an investment option during times of economic uncertainty or instability. When global markets experience turmoil or there are concerns about inflation or political upheaval, investors may flock to gold as a hedge against risk. However, this surge in demand can also lead to spikes in price, followed by sharp drops. While gold may seem like an attractive investment option at first glance due to its perceived stability and security, it's important to keep in mind that the reality is far more complex. Number 3. Gold does not yield a return. One of the biggest drawbacks to investing in gold is that it does not yield any returns. Unlike stocks, bonds, or even real estate, gold does not generate income or provide dividends to its investors. Instead, its value depends solely on market demand and supply. There is also no guarantee that the current high prices for gold will continue indefinitely. In fact, history has shown that gold prices can fluctuate wildly over time. This makes it an unpredictable investment option for those who want steady financial growth over the long term. Enjoying this video? Like and share it, and consider subscribing for more financial knowledge. Subscribe to stay up to date on the latest finance trends. Then let's get back to what we were discussing. Where should you put your money if not in gold? If you're looking for investment options other than gold, there are several routes you can take. Here are a few suggestions. Number 1. Mutual funds. If you don't need your money immediately and are willing to let it sit for a while, investing in mutual funds could be a wise decision. A mutual fund is a company that pools money from many investors and invests the money in securities such as stocks, bonds, and short-term debt. This way, your money is being invested across various stocks and bonds of different companies, instead of just one commodity. By investing in mutual funds, your money is diversified into different stocks, bonds, or other securities. This diversification helps reduce the risk of losing all your money on one investment. Mutual funds offer various types of investments with varying levels of risk. You can choose a conservative option if you prefer lower risk, or an aggressive option if you're willing to take on more risk for potentially higher returns. Another advantage of mutual funds is the convenience they offer. You don't have to monitor individual investments yourself, since the fund manager takes care of them for you. Number 2. Income-producing real estate. While this requires more effort on your part compared to investing in mutual funds or buying gold, it could yield significant returns over time if done correctly. Unlike gold, which does not produce any income, rental properties generate monthly cash flow through rent payments from tenants. When investing in real estate, it's important to research and choose the right property that will yield positive returns. This means finding a property that is located in an area with high demand for rentals and has the potential to appreciate over time. One of the benefits of investing in real estate is that it provides investors with leverage opportunities through mortgages. By using other people's money, or OPM, to purchase a property, investors can increase their potential returns while minimizing their initial investment. Another advantage of investing in income-producing real estate is its potential tax benefits. Rental properties offer deductions for expenses such as mortgage interest payments, repairs and maintenance, insurance premiums, and property taxes. Gold may seem like a safe investment option at first glance, but it comes with its own set of risks and downsides. Number 1. It is risky. Number 2, it is more volatile. And number 3, it does not yield a return. Instead of putting your money in gold, consider investing in income-producing real estate or mutual funds if you don't need immediate access to your funds. These options are relatively stable and have proven track records of generating consistent returns over time. At the end of the day, practicing good financial management practices means being informed about all investment options available to you and choosing the ones that align with your financial goals for both short-term gains and long-term stability. So make sure to do your research before making any investment decisions. Thank you for taking the time to watch. Show your support by liking and sharing this video. To stay informed on key financial topics, subscribe to Financial Flipside and switch on notifications so you'll know when new videos go up.